Quick note before we begin the episode. Episode 200 is fast approaching, and to mark the occasion, Hussam and I will host a special Q&A session with questions from you lovely treasurers. Click on the link in the show notes to submit your question, and we will even send a $10 gift card for our favorite 5 questions. It can be about careers, treasury, Corporate Treasury 101, or even what Hussam's favorite ice cream flavor is. Deadline to submit your question is December 15th. Have a lovely episode.
Welcome to the Corporate Treasury 101 podcast. This is the second part of our full interview with Oscar Coyle, where we discuss short-term investment options for treasurers. In the episode of today, expect to learn what recommendations should treasurers consider for diversification and risk management in their portfolios, how do the treasurer's priority of capital safety, liquidity, and yield align with the investment strategies of the modern era, what are the main differences and options between the US and European corporations when it comes to short-term investment, and like always, much more. We really hope you will enjoy the episode. If that is the case, and when you're thinking about how you found our podcast, chances are that it was through word of mouth, social media, or a recommendation from your favorite podcast platform, or even YouTube. And this is our only request to you. Best way you can support the podcast is to head to YouTube and subscribe to our YouTube channel, Corporate Treasury 101. That will mean the world to us and help much more people learn about treasury.
On another note, this episode is brought to you by Automation Boutique. Automation Boutique is empowering treasury, finance, and risk management with tailored automation solutions. They use robotic process automation, or PA, AI, APIs, and Power Query to create automations that can work with your existing systems. We partnered with Automation Boutique as we really like their approach to innovation and how they help the industry. For this partnership, they came up with an AI-powered automation self-scan that can help you find out if a business process is suitable for automation and how to best get started. It is totally free, non-intrusive, and only takes about 15 minutes. What's great is that the report you will get from the scan helps you determine if the benefits of the automation outweigh the costs. If you want to have a look, head to the link in the description or to automationboutique.com/corporate treasury 101.
And with all that being said, please welcome Oscar Coyle. Okay, makes lots of sense. Let's assume then that we are looking at third-party short-term investment tools. What are the most popular instruments for treasurers right now to park their cash in the short term, especially given the current context? I think you brought up the repo a bit earlier. Maybe we can delve into this type of instruments that are options for treasurers.
Yeah, absolutely. I think, it comes back to that old adage of SLY, so security, liquidity, yield. And I'd sort of like to throw in the fourth term there, which is diversification. Treasurers will always want to be able to be diversified, secured, liquid, and then get an appropriate level of yield. Now, what is popular, as I was sort of alluding to earlier, has been dictated by what is easy to access. So, you can easily access money market funds. You can easily access term deposits. In terms of other options that have been or are available to treasurers, something like a repo, this is usually an instrument which takes a lot of heavy lifting to access. You need to appoint your lawyers to agree your GMRA, so your Global Master Repurchase Agreements. There's a lot of work that goes into setting up those transactions. When you get there, they're great. From a risk-adjusted return perspective, not only are you, first of all, facing a very high-quality bank, but you actually then have this almost comfort blanket of collateral, which can be liquidated at any point given a default. And also, the way in which you're funding that bank from a regulatory capital point of view is very favorable to them, meaning they can pay a higher return. So you can be in this somewhat strange position of taking less risk, but getting a higher return. And that sometimes people struggle to get their head around a little bit. But this is, as I say, this is how the very large investment banks manage their cash. They always do it on a secured basis. I think if there was somewhere where you could access repo much more easily without any of that heavy lifting, this would be a very popular instrument because it kind of ticks all those boxes of security, offering you a way to manage liquidity risk. And we could talk about what liquidity risk is in a bit as well, maybe. And of course, it gives you an appropriate level of yield. But just to think really about diversification, I think it's really interesting, right? We think about diversification on one level really, which is just being diversified across institutions. So a treasurer might think like, I've got 10 banks. I use a couple of money market funds. I'm really well diversified. So if we think about the banks for a second, they're pretty linked. There's contagion risk there for sure. They're all open to the same sort of risks. We saw what happened with Credit Suisse when that was going on. Some of the other banks across Europe were looking a little bit on the edge. So there is a degree of contagion there. So are you truly diversified if you're only ever in banks? And then if we think about money market funds, yes, they invest across a number of different securities and do provide a decent level of diversification. But there's a limited universe to what those money funds can invest in. So if you're in 1, 2, 3 money market funds, you're pretty much just doubling down on credit risk to those underlying institutions. Of course, there's the utility they do provide that diversification. But if you are a corporate with high levels of cash, really opening up another money market fund, it's not adding any diversification. And so I like to think about diversification on those two levels. It's across institutions, so spreading my credit risk, but also across asset classes. So when I say asset classes, sectors, right? So I like to think about the financial sector, so that's your banks, but then also governments and government agencies, so government-like risk. So do I have a way of placing money directly into the government or into an SSA, so a supra, sub-sovereign or agency? Do I have that facility? And then also, is there something in my treasury policy that allows me to buy corporate paper? Because again, that is totally diversified away from those financial risks. So the same risks that apply to all those multiple banks, they're not quite the same when it comes to a corporate. So I think so long as corporates are thinking about, how can I truly diversify my cash? And they've got other places they can place it, which isn't just a bank or a money fund. I think they've got a pretty suitable policy there.
Is it something that you see, companies investing in commercial paper? Like, is it something common? I'm wondering because if we consider banks being risky nowadays, aren't corporates even more? Like, is it something you see in the market? So
it is something we see, that corporates are buying other corporates' paper. That does happen. I'll talk about the difference between the US sort of corporate treasury market and UK/Europe in a second. But if you think about how most corporates view banks and their credit risk, they're using credit rating agencies, right? They're looking at them. They're saying, okay, SAP has this rating, Fitch has this rating. It's above my threshold. It's A- or better. It's okay. I can use them and think done. Whereas actually, a lot of these corporates who are out there issuing paper also have pretty strong credit ratings from these agencies. And so from a risk perspective, if they're rating it as an A and there's a bank rated A, then it's looking pretty good. And as I say, it's offering diversification, which is the key thing. A risk which is going to affect a corporate, if you're lending money to that corporate, isn't necessarily going to affect that bank, but a risk that bank may well then affect that whole banking sector and have contagion. So of course there is risk, and you should put appropriate measures in place to mitigate that, i.e., you may have a monetary limit on how much you can place with other corporates, or indeed, again, a credit rating limit that you have to, they have to be A rated or better, whatever it might be. But I do think there's a place for buying corporate paper directly. And I touched on it just a second ago, but in the US market in particular, this is something which is much more routinely done. Other corporates are appointing, short-term portfolio managers and managing cash in-house and using CP because it's a valuable tool to diversify, but also to get an attractive yield and an attractive risk-adjusted return given the credit rating of those institutions. So it's something like that. Direct securities purchases in the US is much more common than it is in Europe, and you've got to sort of ask why. And I think the answer rather is, there's just the market access there. That there is the way of doing. There are ways of doing it. Whereas here and across Europe, it's limited, but it's growing. And I think that will be something which will be really interesting to see over the next sort of few years as it grows.
It's a lot of reliance on the credit rating agencies there. I mean, I guess with banks, if you're getting your liquidity from a bank, then you kind of only have to watch the financial sector, right? And to see how is the financial sector doing. That's kind of indicative of the economy overall, and people kind of understand that a bit better. When you start going into corporate papers, as a treasurer, do I need to start taking into account, okay, yeah, Fitch rated them an A-, but how is the overall trucking industry doing if I'm getting a logistics company's papers? Or how is the overall software space doing? Or what? You have all these other industries you need to start watching as well, right? Does that not make it far more difficult?
So I think it's a really good point. Reliance on the credit rating agencies. And if you look what happened with Credit Suisse, I can't remember the exact dates, but it took, it was very close to the UBS takeover that they actually got downgraded. So, unless you were looking at the CDS rates, which were blowing up, 6 months prior, then really you might not have pulled out of Credit Suisse if you were purely relying on those credit rating agencies. So do I think a corporate treasurer is ever going to place, 50+% of their liquidity with other corporates? No, that's not going to happen. But a lot of corporates are already exposed to CP via their money market funds. Money market funds are purchasing these instruments. So they already are doing that. If they had a way of buying those papers directly, could they place an element of their portfolio in them? I think so. You certainly wouldn't place a great deal, I don't think, but you would probably use it. Because you're right, it's impossible for a treasurer to stay on top of the trucking industry, the logistics industry, and all of these things, as well as doing everything else that they do. And to a certain extent, that's why there is the reliance on the credit rating agencies, because treasurers simply don't have the bandwidth to, have a team of credit analysts who are working away in the background and looking at balance sheets and whatnot to do those.
Because the complexity of your counterparty risk just goes up as well with it, right? Because of these industries. And we did an episode where we talked about credit rating agencies, and I think if you're sub-investment, you're only getting reviewed every 6 months, and if you're investment grade, you're getting reviewed every year. And a lot can happen in a year, as we've seen in the last couple of years as well, right? So it's...
Exactly. And there are some tools out there which are trying to sort of change this and to allow for better transparency. And I think treasurers should be aware of some of those because they are really interesting. Because it's certainly a space where at the moment it's a little bit opaque. Like you say, they don't get updated quickly enough. They're a little bit backward looking rather than forward looking. And I think there are tools out there which can really help.
I think we covered one in our AI newsletter, but I can't actually remember the name of it.
The credit rating.
No, it was on counterparty risk.
Yes.
It was an AI which was scouring the news for a
specific industry and will tell you because of what's happening. That's the predictive model.
Yeah, and giving
correct. I don't remember the name of it.
We'll put it in the show notes after 100%. We find it, and we'll do that. But it was an interesting company indeed that treasurers could indeed be looking at it. So given all of these challenges, diversification is indeed. So you also mentioned that your money market fund already has these CPs, but probably at a percentage or a diversification which you can't control, right? You could always go into the market for other money market funds and compare different ones and say, okay, this one's a little bit more risky, this one's a little less, and then work accordingly. But then having that flexibility to do it yourself, that's kind of what you're advocating for, right? Which is that, hey, look, you're going to get it anyway, and it's baked into the money market funds. Doing it directly would probably be a little bit cheaper. You probably save on some of the fees, but also allows you to have the flexibility on how much you're diversifying, right?
Yeah, I just think it's another way you can add an element of diversification to your portfolio. I think what's probably more relevant and more comfortable for treasurers is being able to access governments or SSAs, so super sub-sovereigns and agencies. So establishing those connections via whomever may be able to provide it. is really important. So rather than taking bank risk, you can take government risk, and rather than taking government risk, you can take agency risk or sub-sovereign, who carry very high credit ratings, and are probably in most cases majority government owned, these agencies. And so I think, I'm not sitting here and saying all corporates should start buying loads of other CP. It's just another tool, which if you have the access to, you afford yourself that choice, that ability to access it. If you are in money market funds, as I say, you will have an element of exposure to it already. So, don't be so adverse to it. Would be my take.
It's tough to get a corporate treasurer to not be risk adverse.
Absolutely, but it is about being risk adverse. It's about diversifying. That's what it's about. It's about not being purely exposed to the financial sector. Maybe you start with getting access to government bills, right, before that, and SSA paper, and then you think about that corporate risk.
Makes a lot of sense. So in that order of priorities that you highlighted earlier, capital safety, liquidity, yield, you put in diversification in there as well. Have those priorities changed over the last few years with everything that's been going on? Or I don't know if the right question is, have the priorities changed, or rather have the importance or the weighting of each of those priorities changed at all, in your opinion?
Yeah, I think it comes back to what we were talking about earlier. I mean, I definitely think it still runs true. Security, liquidity, yield, and diversification baked in there somewhere as well. In that order, the importance of cash can't really be understated. The importance of being able to pay your staff, pay your vendors, keep the business running, is the utmost priority. So capital preservation, I think, is always going to be number one. What has changed is we have this thing called, interest rates now. 2-3 years ago, we didn't have those. And it made no odds if you invested in an overnight vehicle or in a 3-month term deposit or in a 6-month investment or whatever it might be. Your rate of return was not material, right? It wasn't making a material difference to you. And it wasn't that long ago, right, where we were in euro negative rates. So, things are looking very different now to how they were. And it does take a little while to sort of, I think, change the mindset that actually, if I do term out, there are significant material differences to be made. So I don't think the priority has changed. I still think it's that order. That is how a treasurer should think and does think. But the benefit of terming out has seriously increased and add to it. And so now, a CFO is going to be looking at their cash portfolio, seeing what they've got. All right, we're all overnight. We're only in a current account, or we're only in a money market fund. Is there something else we can be doing to improve the returns on this cash and offset, as we were talking about earlier, the impact of inflation? So I think, just to sort of come back to the question, same order, definitely of priority, but it's now got this added element of, actually, I can add material returns to my cash.
You said something else very interesting here, Oscar. You brought in the CFO. So whilst we focus on the different options for the treasurer, as cash is becoming emperor, if I may do the pun with cash is king, has the importance of cash become so big that now CFOs and even maybe boards, in your perspective, are looking into what type of investments are made? Because now it's not about, whether we get 0.2% or 0.5% on our excess of cash. Now we're talking about 10 times the amount. Is the importance of cash becoming so big that it's looked upon by higher up people in the hierarchy?
Definitely. And just to touch on your point there, cash is emperor, I really like it. I mean, I heard cash is trash a little while ago, but I don't think that's ever true, right? It's never trash. Sure. And I think emperor or empress or king or queen is definitely right. And yeah, from my experience, it's certainly taking more attention from top of house. I think talking to treasurers, there's a little bit more impetus on, not only keeping it safe and making sure it's appropriately managed from a risk perspective, but also thinking about how am I making it work better for us? Because, like I say, the environment we're in now is just hugely different to what we were in a few short years ago. And one risk we haven't touched on much is that liquidity risk, because of course, you can tie up cash, but if you're in a vehicle you can't unlock at all, there's an element of risk there. But of course, you can also be in maturity transformed vehicles like a money market fund, where you're getting same day access, but actually your cash is spread across instruments from 1 day all the way out to 12 months and sort of everything in between. Although you get same day liquidity on 100% of your cash, and so does everyone else. So there is a degree of risk there, because if more than 20% or more than 30%, depending on where the cash is managed, want to get their cash out, they're not going to be able to. And then there could be a run on the fund. And so this is something that needs to be thought about. And it is thought about, there's been various different sort of fees and gates have been implemented into the money fund industry to sort of offset this risk. It does seem to be changing all the time with where we are. But it's just another element of risk that people need to be thinking about when managing cash. But look, I definitely think cash is top, perhaps not top priority, but it's certainly up there, and certainly is cash is emperor or something like that.
Getting there. I think according to recent surveys, cash flow forecasting is the number one priority of CFOs and treasurers. So not directly, okay, where are we going to invest our cash, but pretty close to it.
Yeah, and I think with cash flow forecasting, right, if you have that, buttoned down, that then leads to the ability to then manage cash better. It means you can invest it further out. It means, right, I know I'm not going to need this pocket of 50 million for the next 3-6 months. I can go and find out where I can place it in a cash vehicle to get a higher return, because I know I'm not going to need that. It's cash flow forecasting is an interesting one, because it always will come back to, I think we talked about trash already, but garbage in, garbage out in terms of cash flow forecasting. So these tools are great, but it's all about getting the right data. And if treasurers can get that right, get the right inputs from their various different teams across the world and everything, and then they can get a great sight of where their cash is and what position they are in their cycles, and then they can manage it more effectively, then we're on for a sort of a golden ticket, if you like.
100%. Something you brought up earlier is the difference between the US and Europe. Could we dive a little bit more into this? Like, if location plays such a big role in short-term investment decisions from treasurers, from your perspective, what are the main differences in terms of markets and landscape between the US and Europe? Mm-hmm. And therefore, what are the consequential options for treasurers between those two regions as well?
Yeah, definitely. I mean, there's a few key ones. I think, and look, I'm not sitting here saying I'm an absolute expert and I know, exactly what every US treasurer thinks compared to every European treasurer. But broadly speaking, I think US treasurers maybe are viewed slightly more as a value add sector, in that, you can grow the business. So you take this cash and you make it work harder, you invest it. And that's why these short-term investment portfolio managers are coming in, and they're actually managing the cash more like a portfolio. It's why seg mandates are more popular over there. So people are going to asset managers and saying, here's a big pool of cash, look after it for me, manage it within these confines or what have you. We have those in the UK and across Europe, but it's not quite the same level of popularity. So I think that's one thing. In the UK and Europe, it's viewed as more about, protecting that treasure, protecting the cash and making sure it's there for the people who need it. And if you can get a bit of a return, then that's great. Obviously, what we've just talked about is that that's changing slightly. And I think it will continue to. But yeah, there's certainly a difference in that respect. And then, we touched on it again earlier, but it's about the access the US treasurers have. And there's much more openness to direct security purchases. So buying US T-bills or investing in US government bonds, further out the curve. Or, as we talked about, buying corporate paper or SSA paper. There are plenty of market makers out there who are doing this in the US, and it just seems more commonly done than what we do here in Europe. And I think they're sort of the two of the key differences that I sort of found over the last sort of few weeks being over there at the AFP and whatnot. Things are fluid, and of course they vary from company to company. You have some companies here who are really looking for that higher return in their cash portfolios, and then you have companies who don't care. So there's a cultural element both within the region they're in, but then within the company itself.
Oscar, one of our favorite exercise on the Corporate Treasury 101 is to chase down and break acronyms to make them understandable. We've touched upon quite some that we've already touched upon in the podcast, so it's fine. But you mentioned SSA paper. Could you explain what that is, please?
Yeah, look, so it's just a broad term for the supras, sub-sovereigns and agency world. So these are exactly that. So they're supranationals, so which are government-like organizations who go out to market and raise debt. So they might do that via issuing paper, issuing bonds, and you purchase these typically via a broker-dealer. And so these often carry a high credit rating. So because of their ownership structure, they might be 60% government owned, 70% government owned, or they might be 100% government owned and raising debt on behalf of the government. So it's another place where treasurers can diversify away from purely financial risks or purely corporate risk or wherever else you might be spending cash. Yeah. And sometimes people just refer it to as the agency market.